Alright, well, I guess I'm done buying silver. I was gonna try and buy some more silver before it got over 100, but I was gonna go back to Ohio and buy it from that guy. But I got up there and he was closed for the weekend. So now it's over $100 an ounce. I don't think it's gonna go over 500 an ounce. I'm just hoping it does, because if it goes up to 1,000 an ounce, I'm gonna sell pretty much all of my investment and pay off all my debts, because I have enough silver to pay off all my debt and I'll be debt free if it goes up to 1,000 an ounce. If it only goes up to like 500, which I think it will, then I'll just cash out the 10 ounces that I bought the other week at $80 an ounce. All the stuff that I bought at $25 and $35 an ounce, I'll probably hold on to for a while. Save it as like an emergency plan. Ideally, well, what I'm trying to do right now is focus on passive income so I can retire. And then, or semi-retire at least. And then start focusing on stockpiling assets, for emergency funds, or to pass on to the next generation. Maybe not my kids, but my brother's kids. So, yeah. But for the most part, I don't want to retire broke. I've been trying to invest all this money into all these different business ideas and whatnot, trying to get ahead, and nothing's really worked. The only thing that's actually worked for me is paper assets and renewable assets. I got 15 acres that I was raising my sheep and goats on, but I got this new neighbor that I think has been killing my livestock. Not the adults, well, the birds. They killed off over half of our birds. And then we lost all of our lambs and baby goats last year, except for one. So, and then the neighbors are like, oh, it's coyotes. Well, I never had a coyote problem until you guys moved in. So, what is the problem? Anyway, so I've sold a third of my herd. I'm butchering another third next weekend, or next week, and I'm just gonna kind of reorganize. I don't have enough fencing on the 30 acres to move all the livestock to the 30 acres. The only fencing we have is the fencing that Laura did for her guinea fowl. So we're kind of screwed. So I bought these GPS shock collars, and I'm testing them out. And so far, so good, sorta. They're not working as good as I had planned. However, I did find a better one that actually has like a solar powered charger, built-in charger. So I'm actually gonna, because I was using a GPS dog shock collars, but you gotta recharge them every day. And so I'm thinking about investing in these other ones that have the solar panels built in. Then I only got to worry about charging them every like 4 to 6 months. So I might go that route. But what we decided to do, at least until we get proper fencing, is we don't really have a choice. If I want to keep my herd, or at least keep my breeding stock, I got to keep them on the other property. Yeah, we haven't lost any adults out of the sheep and goats yet, just all the babies. And I'm 99% sure that their dogs are doing most of the damage, but they know their dogs are doing most of the damage and they're refusing to do anything about it. We didn't have any evidence until December that their dogs were doing it, and then once we called them on it, all holy hell broke loose. So obviously they knew about it and they refused to do something about it, and when we want them to be accountable, they basically attack us. So very narcissistic situation. Anyhow, so I sold a third of my herd, or at least a third of the goats, and I got like $1,500 almost, so not too bad. But so I'm investing that into the mobile home, because we're still trying to get that mobile home out of foreclosure. But so right now I'm just focusing on that. I'm not gonna buy any more silver. I'm just gonna wait. I'm just gonna invest, well, I'm not really investing in dividend stocks anymore right now. I'm just reinvesting the money that I make off the dividend stocks. Right now my portfolio is up 12%. Now that's counting dividends plus cash value. So the cash value is down, yet the dividends are up. So I'm averaging 12% return on my investment, which ain't bad. So so my next step is basically I'm just reinvesting my dividends. I'm not doing a automatic drip. I'm doing what I call a manual drip. So when I get paid the dividends, I'll go in and look and see what they paid. And another thing, I talked to my Edward Jones broker, and basically he said I'm basically doing this right, with the exception of, maybe only investing in high yielding dividend stocks. But which, by the way, this SUI, that's a glitch. It's not worth that much. I don't know why it says it's worth that much, but it's not worth that much. But anyway, let's go to Zim. I like Zim. I was looking into options because I was like, what is an option? I was looking at Webull, and I really didn't understand what options were, but Webull was saying, I don't have any stock, or I don't have any options. All my money's in stocks. And I'm like, what are options exactly? So I Googled it, kind of explained it, but then my Edward Jones broker kind of explained it more. I think I'm going to stick with just dividend stocks. Things that give me a passive income. So I should have kept my money in Zim and cashed out today instead of when I cashed out, because it'd be worth more money today. But that's okay. So I still haven't quite figured out how to read this PE ratio, the P/E 1.4, but it basically is similar to the earnings per share. And so what I do, and I talked to my Edward Jones broker, and he said that this is a pretty good way of judging a stock without actually looking into like the CEO and how you know, you can do some investigation on the actual company and see how they're doing and how they're managing their company, blah, blah, blah. But if you don't really have time to do that, then basically what you do is you go in here, you see how the stock is doing for the last 5 years. Like, Zim's only about 5 years publicly traded, but they've been in business for almost 100 years. After they went publicly traded, their stock skyrocketed, and then it went back down to where they opened at, and it's pretty much been stable. $15 to $20 is like the norm, and their stock has paid on average about 30% dividend yield on average. So I think personally Zim is a stable stock. Who knows? But anyhow, I only cashed it out because I needed the money, and I could have waited, but I'm trying to stockpile money for that mobile home, because we're going to get a good deal on it if we can come up with enough cash. So basically what I do is I'll look at the dividend. So say it's paying 18.38%. Then I go over here, look at the 5-year growth. If it's down for the last 5 years, then I would only throw in $18. If it's up for the last 5 years, I'd throw in $180. But another thing I look at too is the earnings per share. So the earnings per share is in the positive, not the negative. So if it's in the negative, you probably shouldn't buy that stock. And if it's in a positive, that means they're actually making money. So if their earnings per share is $16.63, that means they're making $16.63 per share. Now, and they're paying us, hang on, $3.17 per share. So basically, overall, it's a good buy. Now the PEI, or the PE ratio, you would think that if it's in the positive, you should buy it. If it's in the negative, you should not. But I've been told otherwise. So I really don't know how to read the PE ratio, the P/E. So if you can look at the earnings per share, that's what I would look at. If you cannot, then you got to look at the PE ratio. And I still got to learn how to read that. But I think, Zim is a good investment. Even though the stock is down for the last 5 years, if I had the $180 to throw in there, I would. Zim has always been a good investment for me. The only time that it was, I wouldn't say sketchy, but we had some concerns, was in 2024. They didn't pay out any dividends for a whole year, and then at the end of the year they dropped their dividend to 1%, and before that it was like 100%. It was like, whoa. So I got my brother in, I got my girlfriend in, I got my dad in, and then once it started going back up, they cashed out. Once they broke even, they bailed. I stayed in, I made money off the cash value side, which is right here. Hang on. Here we go. I sold basically $3,000 worth, 130 shares at 21 an ounce, $21 a share. But I bought a lot of it down here. So I don't remember what my average buy price was, but basically I ended up making the $1,000 on the cash value side that I was supposed to make on the dividend side. Granted, I had to pay higher taxes on that, but you know, I got my money that I needed, and I actually did need the money, so I cashed it out, and boom. I should have kept it in, but you know, whatever. I kind of treat my stocks also as like my emergency fund. So when I need money and the stock is up, then I might cash it out to pay some of my bills. Like I just made $1,000 off of ARR in Cash App, because I'm trying to cash everything out in Cash App. I don't remember exactly what I made. It wasn't quite 1,000, but it was pretty close. Maybe it was. Let me go back and look. I mean, I didn't actually make the money because it was just above breaking even, but I had a lot of money in there. Come on, work with me now. There we go. Let me check this real quick. Okay, nothing's up. I try to only cash things out when they're up. So ARR. Okay, yeah. I cashed out $1,000. Now I didn't make 1,000. Let me see if I can. Oh, I was probably there in the first place. Here we go. Okay, so net profit. Oh, that's them. What's my profit? See, this is a good one to invest in too, because I basically got 15% return on my investment while I was waiting for the stock to go back up so I can sell it. And I kept buying it while it was down. So I should have moved that $1,000 over to Robinhood and reinvested it into ARR, but instead I cashed it out and I put it towards this mobile home that I need to save up money for. But anyway, I guess it's not going to tell me what my profit was. But yeah, basically, every time I got paid, I'd look at, like right here, December 29th, I got paid $13. So I went in and looked at the dividend yield. It was about 16%. So I threw in $16 because the stock was down. It was going back up, but it was down. Then I cashed out January 7th when it went up even more. So, but before that it was down. I made $12, put in $17 because it was paying 17%. Before that, it was paying 20%. You know, it was fluctuating. But yeah, I just kept, here I threw in a bunch of money, I don't know why. But anyways, but typically, oh, like right here, I threw in $160 when I should have just threw in $16. But that's okay. It went back up. I made a couple bucks, and I broke even. But I also made a butt ton of money. Maybe not a butt ton, but I made a lot of money off the dividends. So even though I didn't make too much money off the cash value side, while I was waiting for the stock to go back up, I made a good chunk of change off the dividends. That's why I love dividend stocks. Even if you don't make, even if the stock doesn't go up, even if it stays the same, and you make no money at all off the cash value side, you're cashing out over here. Boom, boom, boom. But anyway, I lost my train of thought. But basically, right now I'm just trying to save up money to invest in getting this mobile home at a discount. The people that we bought the land, or was buying the land from, they basically they weren't paying the bills we were paying them to pay. You know, so we were owner financing it. We were giving them $1,000 a month. They were supposed to be paying the bills, and they weren't. Everything went into foreclosure. So we ended up having to lawyer up, and we ended up having to buy everything out of foreclosure. We got the land. Now we're just trying to get the mobile home. So, and we were going to take the equity out of the land to get the mobile home, but we now have a clouded title, so we can't do that. So once we get the mobile home, they owe $30,000 on it, but it's not even worth $30,000. It's only worth $20 tops, and it's going to cost them $15,000 to move it and reconsign it. So if they resell it, they might maybe make $5,000 or $10,000. So we're going to offer them $10,000 and see if they're going to take it. We have together between us, I think we have $5,000 or $6,000. So we still got to come up with another $4,000, and then boom, we'll own that free and clear. Then all I got to do is what I'm thinking about doing is I have on that 15 acres where I have my livestock right now, is well, once all the females have their babies, what we're doing is we're taking the females when they have their babies, and we're taking them off that other property and bringing them to our new property. And we're basically raising them there. We have to buy hay and feed them hay because we don't have enough. We can't, we'll let them roam. We can't let them forage because we ain't got fencing. So we have to buy hay. So basically for 3 months, we're taking the moms and the babies to our Collins property and feeding them there, taking care of them there to make sure the babies grow up to be strong and healthy and be able to protect themselves against predators. Then take them back to the 15 acres. After about 3-4 months, they should be big enough and strong enough to fend for themselves. Once maybe this time next year, I might just sell off all the sheep and try again later. Maybe. I don't know. We'll see. Or, yeah, I don't know. So, then, I'm just going to keep my prize buck and my weather and just a couple goats. And next year, or later this year, when we get proper fencing, I might get some, because I got a mini Nubian buck, and I was I got these other female goats that I didn't really know what they were. The guy sold them to me. Told me they were Nubians, but they weren't. Well, one of them was. The other three, they were mixed. They were mutts. They had a little bit of Pyrenean in them, I think, and they also had a little bit of cashmere in them, or something else, a long hair goat. So, because they were hairy goats, and so they were mutts. I don't know what they were, but then I bought them for my weather because he was lonely, and I just bought them as friends to keep, him company. And then I was gonna sell them when I figured out what direction I was gonna go. And I bought a mini Nubian buck, and he's like the best buck ever. And I just bred him with them, and they've been producing me food. So I was like, hey, fuck it, this is what I'm gonna do. But now, the smaller goats aren't producing big enough goats to produce food. So what I'm gonna do is I'm going to replace them with Kiko Spanish goats later when we get more fencing. And then I'll go back to my original plan. What I was going to do is I was going to get Kiko Spanish nannies and breed them with a Nigerian buck and make what I called a Skygerian. But now I'm going to take my mini Nubian, which is half Nubian and half Nigerian, and breed him with the Spanish Kiko nannies, and it'll pretty much be the same because Kikos have Nubian in them. So that will give me a bigger offspring than if I just bred them with a Nigerian, because Nigerians are small. So taking my mini Nubian, which is a Nubian Nigerian cross, and he's not small, but he's not huge either. Crossing him with my Spanish Kiko goats nannies that I get in the future, that'll give me a decent sized meat goat to take to the butcher, but they won't be too big where I can't handle it. But anyways, and at that time I will have fencing, and I'll probably have these solar powered GPS shock collars. But I won't have the money to pay for fencing for the whole property right away. We're gonna start out with just 5 acres and then use the shock collars to let them out, here and there. But anyhow, only certain ones. And then if they don't obey their collars, well, then they don't get to go out. I'll just put the collar on somebody else instead. Let them out. But anyhow, so yeah, what I'm going to do with that 15 acres is it's a 2-parcel, 15 acres, and I'm going to refinance the back half or the front half, whatever I'm allowed to do. And then I'm going to subdivide the whole property into 4 properties. Split it down the middle. So I'll turn the 2 parcels into 4 parcels, and then I'm going to owner finance them. Once I get all my crap out of there. I got to get my stuff off the property first. But I'll owner finance it. I have a management company that's going to manage it for me. They'll get the 10%. I'll charge 10% owner finance. I'll give that 10% to the management company. And then I'll have that monthly income coming in, that passive income coming in every month. So that'll turn that property into a passive income investment property. And if the people don't pay it off, well, then I can take it back and sell it to somebody else. If they do pay it off, great. So, and I'll just make sure that I sell it for more than I got in it, and then that way I make a profit. But and that'll piss off the neighbors, which will make me happy, because they've been trying to ruin my life by tampering with my fencing and either killing or allowing their animals, their dogs, to kill my animals, or both. So I thought about trying to find a rehab recovery farm to lease the property. That'll really piss the neighbors off. But anyways, it's partially about revenge, and it's also about making money. So getting a return on my investment. So yeah, silver is probably, like I said, I would probably, maybe, if I didn't have other things that I needed to buy right now, I'd probably buy some more silver till it reached about 200, 250 an ounce. That'd be the top dollar I would spend for silver. But from what I understand, during quantitative easing, we want to buy paper assets. And during quantitative tightening, we want to buy renewable assets. But basically, just watch the market. When the stocks are down, buy stocks. When renewable assets are down, buy renewable assets. But right now, renewable assets are reaching an all-time high. So it's like we're almost to the window of buying renewable assets is about to close. And now it's time to just focus on paper assets. And then once the renewable asset prices go down, then we back off on buying paper assets and start buying more renewable assets. So yeah, once the real estate market pops and it goes back down, I'm gonna buy more land, subdivide it, and then owner finance it out, and then use the management company to do all the work. That way I ain't got to worry about it. All I got to do is collect the money, make sure the bills are paid. Boom. But yeah, and I'll be taking that money that I get from that renewable asset and putting it into paper assets or more renewable assets, whatever the best advantage is. So yeah, use your renewable assets to pay for your paper assets. Use your paper assets to pay for your renewable assets. But you got to figure out a way to make or have your renewable assets generate you a passive income. And that's the hard part. So paper assets, that's easy. You can do dividend stocks or stack crypto. And although stacking crypto hasn't shown to be very lucrative for me, dividend stocks are definitely a lot more lucrative than stacking crypto. But yeah, buy some crypto, buy some dividend stocks, buy some silver, buy gold, buy what is this other stuff? Platinum, palladium. There we go. Right now, platinum is cheaper than gold. So is palladium. So now might be the time to be buying platinum and palladium. Although palladium looks like it's up quite a bit. Copper. Yeah, since silver's going up, people's gonna stop using silver for conductors and whatnot. They'll probably go back to copper. And yeah, I wish I had a chart to see what it was worth 5 years ago. I mean, I guess I could. I'd go to Robinhood. But another way to make passive income off of gold, silver, all this stuff, copper, is to invest in the mining companies that pay a dividend. It's a paper asset, but you're investing in the mining companies that are producing the renewable assets. So that's one way of doing it. But yeah, I think gold and silver, copper, all that stuff, it's pretty much like they normally say, it's just a hedge against the dollar. A hedge against inflation. But anyhow, yeah, so the main reason I wanted to make the video was to talk about the PE ratio and the earnings per share, because I talked to my Edward Jones broker, and he said that's basically the best way to look at it. Like this company here, the earnings per share are in the negative, so it's probably not a good investment. I have been reinvesting a little bit. This guy keeps speeding up and slowing down on me. Anyways, everything I bought ever since I started buying it, it's pretty much gone downhill. This guy, I get behind him, he slows down to 65. I go to pass him, he speeds up to 70. I can't go any faster than 70. Now that I try to pass him, he's going to speed back up again. Okay, I got him trapped behind this other slow truck. Stupid truck drivers. I always think it's funny when truck drivers say that. You know, it's like when we yell at other truck drivers and we say stupid truck drivers, other people are like, what? But anyways, it sounds funny saying that coming from a truck driver. But anyhow, there's stupid people out here driving all kinds of vehicles, not just cars, not just trucks, not just motorcycles, although I think there's a lot more dumb motorcycle drivers than there are most of these other vehicles. It's like they want us to watch out for them, yet they drive like stupid idiots. It's like you're driving 100, 200 miles an hour. I don't even see you before you come right up on my ass and pass me. It's like a lot of times they scare the shit out of me while they're passing me, and I didn't even know they were there because they're going so damn fast. 1 minute they're not here, 1 minute they're here, and then they're gone again. You know, I saw a video of a motorcycle driver doing who knows how fast, probably over 100, and a truck driver didn't see him, changed lanes, and the motorcycle driver was going so fast that it couldn't change lanes and smashed right into the back of the truck, the 18-wheeler. You know, obliterated himself. You know, it's like, and these trucks, they're governed at like 65, 70. Most of the trucks are governed at 65 or 70 or somewhere in that range. Between, well, I would say in the range of 60 to 75. There's some trucks that still pass me, and there are some trucks that's governed less than 65, but most of them are governed between 65 and 70. You know, and if we're struggling to pass somebody, that's because we're both governed at about the same speed. Or, like when I was in Chicago earlier, I was doing 70, passing people, and these two cars decided to speed up. While I was in the left lane passing them, they decided to speed up to where I couldn't pass them. And then the people behind me are flashing their high beams at me like I'm the asshole, like I'm the problem. It's like, I would have been, you know, not in the left lane, I wasn't passing. I'm not one of those left lane losers that hang out in the left lane all day long. I'll be in the right lane or the second to the right lane. Except to pass. So, or like in this case, there's emergency equipment on the side of the road, or whatever, construction equipment on the side of the road, so I move over. But but yeah, a lot of people don't understand that a lot of these trucks can't go any faster than 65 or 70. And these newer trucks, they got these sensors on the front of the trucks where they make your truck adjust to the speed of the vehicle in front of you. And the newer trucks, the cruise control, like say, for example, this company, say the cruise control is set for 70, and you're coming up on a truck or another vehicle that's doing 68, you can't put your foot in it to bypass that sensor. So right now I got my foot in it to bypass the sensor so I can pass this guy. I can get right up on him and then I bypass him. That's my truck beeping at me saying, I'm too close, I'm too close. So what I do is, you know, when I come up on a slower truck, I just put my foot in it and I get right up on them, and then I can jump out the pass. You know, I bypass that sensor because that sensor keeps me at 300 feet, 400 feet, depends on the situation. It depends on the truck. Some of them you can adjust the sensor, some of them you can't. This one I cannot. So I'm coming up on a slower truck. My sensor kicks in and says, oh, time to slow down. So I put my foot in it, get right up on them, then I jump out the pass, and then I can let the cruise control take over. But these newer trucks, if you put your foot in it, it'll slow you down to 65. And it's like, what the hell? So you're stuck, like Chuck. You can't pass anybody unless that somebody is doing less than 65. So then, so I'll say I got my cruise control set at 70. I'm coming up on a 68 mile an hour truck. I put my foot in it. Boop. Now I'm doing 65. So I don't have a choice. I basically have to do 68 or 65. you know. So I have to just sit there and suffer until I come up on a truck that's doing 64. If I'm coming up on a truck that's doing 64 or less, then I can put my foot in it. It'll derate me to 65, but at least I'm doing more than 64. Then I can slowly creep up on them, then jump out the pass, and then let the cruise control take over. Then I can do 70 and get around them pretty quick. But with these newer trucks, if I jump out, if I don't want it to derate me to 65, well, I have to jump out. Well, I'm like a football field away, and if I got people behind me, they're pissed off that I'm hanging out in the left lane. So that I look like one of these left lane losers who's just hanging out in the left lane. So it's like, it's annoying. It's really annoying. But anyhow, once I get my dividends up, I won't have to worry about it no more. That's my goal. So, anyways. A little bit of trucker's ad for you. But, yeah, ORC, how are they doing? They're down. Their earnings per share is up, so that's good. So yeah, basically what I would say is look at the stock. Like right now, I'm buying stuff that only pays more dividend yield than the interest rate on my debt. So like this one's paying 17%. Well, my debt, my biggest interest rate on my debt right now is my credit cards. Once I get my credit cards paid down, then my next biggest debt is, or my next highest interest rate is my pickup truck. Once I get that paid off, then my next highest interest rate is the mortgage on my land. So I'm basically using that as my marker. Is it smart? Probably not, because I'm only investing in high yielding dividend stocks. Not only 99% of my money or 90% of my money is going into high yielding dividend stocks. I do buy some lower yielding dividend stocks, but not that much. I'm trying to get my income up. So right now I'm just mostly focusing on high yielding dividend stocks. So what I do is I go in, look at the dividend yield. If it's more than what I pay in interest on my debt, and I'm working on getting that debt paid down. So once I get the credit cards paid down and I'm paying them off weekly or monthly or whatever, then that's a non sequitur, you know. So then I'll just look at my interest rate on my pickup truck. But by then I'll probably have it paid off too. So by then I'll be looking at the interest rate on my real estate. And so then at that point, if I refinance, it's going to be about 7%. So at that point, I'll be mostly investing in stuff that pays more than 7%. So then at that point, this one would qualify. So then I would go in and say, okay, 17%. All right, so it's more than the interest rate on my debt. Eventually, right now, it's not, but that dividend yield fluctuates. So sometimes it's 20%. So if it is 20%, then I would buy some. That being said, then I would go over here, look at the long-term growth. It is down overall. So I would only throw in $17, or was it 18? 17. So if I was to buy it today, I'd throw in $17 if the earnings per share was up, and it is in the positive. Now see, the PE ratio is 16. What does that mean? I don't know. If somebody has education on that, you know, let me know, because I'm still trying to figure that out. Still trying to understand it, because it doesn't make sense to me yet. But their earnings per share makes sense. So they're making money. It's only 52 cents on the share, but they're making money. Now, are they making more than what they're paying out? Let's go look. Yes, they're making more than what they're paying out. So, this is definitely a somewhat stable stock.
In half a mile, keep left onto I-64.
Now, it's down for the last 5 years, but for the last year, it's somewhat stable. It was up, it was down, it kind of stabilized, and now it's back up a little bit. So, yeah. But right now the dividend yield is less than what I'm paying in interest on my debt. So I'm not buying it right now. But if it drops, if the stock goes back down and it's paying more than the interest rate on my debt, then I'll buy some more. And the idea is to buy low and sell high anyways, although I'm not planning on selling unless I need the money, you know, if I'm treating it like an emergency fund. Because I do have a couple $1,000s in emergency fund, but most of my money goes into dividend stocks or my bills. But yeah, I'm trying to do the 70-15-10 plan, although my 10 and 15 are all in dividend stocks. I don't really put any money in savings. That being said, I should have been putting that 10 or 15% into silver. Hindsight's 2020, blah blah blah. So yeah, if you follow the 75-15-10 plan, I would use gold and silver as my savings plan when gold and silver is down, and or you know, some kind of renewable asset, real estate, precious metals, gems. We don't talk about gems too much, but they're a renewable asset as well. Not diamonds so much. Diamonds are overinflated, but black diamonds are valuable. So maybe buy some black diamonds if the value is down. I don't even know how to look that up. Well, that's not what I was looking for. So yeah, black diamonds are valuable. Anyways, I gotta pull in this rest area and go to the bathroom. But yeah, check out the stock. See what it's been doing for the last 5 years. If it looks like it's stable, or even the last year. If it doesn't look stable for the last 5 years, how does it look in the last 1 to 2 years? Has it stabilized? If the stock is down, does it still look somewhat stable? Look at the earnings per share and the PE ratio if you know how to read that, and then buy accordingly. How you invest, how I invest are two different ways of investing, but I'm just giving you my insight and how I do things to kind of give you an idea. And so far, I'm doing pretty good. That dip right there was when I cashed out my Zim. But yeah, my portfolio's actually doing better than the S&P. So, and I'm making more money in dividends than I would if I had my money in the S&P. So, granted, my stocks, my cash value side is down. But I'm getting almost $3,600 a year in dividends. My IRR is in a negative. Well, I don't know. It's kind of balanced out. Almost. It's still it's 5% in the negative, I guess. I don't know, between those two numbers. I still got to figure out how to read that too. But my 5-year growth is up 2%. That's good. My dividend yield is 24%. Yield on cost, 22% almost. So, altogether, profits and losses, I'm up 12%. And once the stocks go back up, then I'll be doing even better. I'll be doing like 30%. Because stocks on average go up about 10%. So on average, I'm going to probably, once I start buying lower yielding dividend stocks, I'll probably average between cash value and dividends 20%. But yeah, right now I'm averaging about 12%. So still not doing too bad. So like I said, as I start investing in lower yielding dividend stocks, I'll have more stable stocks. And so you'll see the cash value number go back up. And so this average will probably average closer to 20% return on my investment. Although I won't be cashing anything out. I'll just keep stacking my dividend stocks, because I want to get this $3,600 up to $100,000. So that's my goal. So there you go. All right, party on. Bye.